Hi, everybody. Welcome to our webinar on understanding HR1, the One Big Beautiful Bill. My name is Alyssa Hicks, and I'm a Senior Marketing Coordinator here at OnPay. We are so excited to have you join us and really appreciate you taking the time out of your busy schedule to tune in today. Here at OnPay, we've partnered with one of our very own subject matter experts to bring you a clear breakdown of what you need to be aware of with this new law in place. Before we meet your presenter, just a little bit of housekeeping. This session has been pre-recorded, so all attendees are in listen-only mode. We'll be sure to email you a recording and recap of the webinar later today, but for now, feel free to ask questions in the sidebar labeled Questions of GoToWebinar. We will relay them to our team to touch on at a later date and time. And please note, the information in this webinar is for educational purposes only. This is not meant to be legal, tax, and financial advice. Now, with further ado, let's meet your outstanding presenter. Here with us, we have Noel Lorenzano, CPA. Noel, the floor is all yours.
Thank you, Alyssa. Hi, Alyssa. Thank you for the lovely introduction. I really appreciate it. I really appreciate the opportunity. And yeah, I'm really excited to be here today because the One Big Beautiful Bill, as you know, is a sweeping new tax law. It was signed in July of 2025, and it makes some of the biggest changes we've seen in years. And we're going to touch on a lot of those topics. And just real quick about myself, I've got over 25 years experience as a CPA. I've been an OnPay subject matter expert and content contributor since 2023. And the reason I became a CPA was I worked with my family business, and I actually struggled with bookkeeping and taxes early on, and I really wanted to figure it out and level up. Currently, I'm a YouTube content creator and a small business owner / entrepreneur. I like to think that I help freelancers and entrepreneurs and businesses simplify their tax prep, tax filings, and any IRS challenges they might face. So going on to the first slide here. So our webinar agenda for today is no tax on tips, overtime, and the new 1099 changes, and also bonus depreciation updates, small business tax advantages, and employer considerations. And as Alyssa mentioned, time permitting, at the end, a questions and answer section. So moving on to the next slide, we have the no tax on tips provision. And here are the details. So what's changed? So no tax on tips, that's up to a point, and that limit is $25,000. And it's for workers in tip-heavy industries. They could see real federal income tax savings, but they'll still owe payroll taxes. So who benefits? Industries affected are those where tipping is customary. Think restaurants, hotels, transportation services, personal care, and delivery services. Now, there are some important limitations. The tips must continue to be reported properly. Cash tips remain subject to specific documentation requirements, and employees still owe Social Security and Medicare taxes on those tips, and so do employers. And a few other things to mention for employees or for individuals. Another thing to mention, these tips should be properly reported on the W-2. And interestingly enough, right now it's only for voluntary tips. That's the way it was written in the bill. So mandatory tips, something that you might find going to a restaurant with maybe 6 or more people, sometimes they add on a mandatory tip of, say, 15 or 20%. So technically, that's not included, but there is legislation trying to change that and trying to simplify that. So just keep in mind, this guidance is still pending, and so is legislation. So keep an eye on this for future updates. And do note this is effective for tax years 2025 and 2028. And the US Treasury actually leaked a list of tip eligible jobs. Now, this isn't official, but it's pretty good guidance for moving forward. And their list included 68 jobs eligible for the new tax deduction on tips. It was leaked to the media, and it was first reported by Axios. So who qualifies? It covers a wide range of occupations where tipping is customary, including food and beverage service. These are like bartenders, wait staff, cooks, hosts, fast food workers, entertainment and events. These could be like dancers, musicians, DJs, performers, gambling workers, and even digital content creators. And also hospitality, which are like hotel staff, concierges, bellhops, housekeepers, home services, cleaners, repair workers, landscapers, plumbers, electricians, personal services, maybe tutors, nannies, pet sitters, photographers, event planners, appearance and wellness, barbers, hairdressers, manicurists, recreation and instruction. These could be like sports instructors, golf caddies, tour guides, and finally, transportation and delivery. That could be for rideshare drivers, delivery workers, movers, or even valet attendants. So just keep in mind that for tips, the deduction is available starting in 2025, and that goes to 2028. And it also applies to individuals who are self-employed. So you would have to track those tips yourself. And generally, don't forget, IRS recognized tipped occupations. So myself as an accountant, I do, believe it or not, occasionally receive tips. So those aren't included. So keep in mind, only qualified tips count, voluntary cash, card tips, or even tip sharing. So look out towards the end of the year for the official list to come out from the US Treasury. Okay, great. So let me know if you have any questions on that. You can leave those in the comments or in the chat. And moving on to the next slide, let's talk about overtime. Overtime gets a break too, and this is also between 2025 and 2028. So individuals can now deduct a portion of their qualified overtime pay up to the following limits. So that's $12,500 if filing single, and $25,000 if married filing jointly. Now keep in mind, the deduction applies only to federal income tax withheld on overtime premium pay for hours worked above 40 hours in a week. And the deduction does phase out for higher income earners, those with an AGI or adjusted gross income over $150,000 if you're single, and $300,000 for joint filers. Mention that this would be reported on your W-2 by the employer. So employers, you need to be sure you're tracking overtime pay because you're going to need to report that on your employee's W-2 starting in 2025. And for employees, this would be claimed on your personal tax return, Form 1040. And just to recap, the Fair Labor Standards Act, FLSA, instructs employers to pay overtime compensation to any employee who works more than 40 hours in any work week. And overtime compensation is equal to 1.5 times the rate of regular pay. So moving on to the next slide, why does it matter? For both the tips and overtime, it's an above-the-line deduction, which lowers your employee's adjusted gross income, or AGI. And that can really help with things like qualifying for loans, other tax benefits, or income-based programs. Now, keep in mind, your AGI affects just about everything on your tax return. It determines how much tax you owe, what deductions or credits you might qualify for. So think of AGI as a starting point that the IRS uses to calculate your taxes. So keeping it low legally can actually save you money. Now, you may have heard the terms above the line and below the line. Above the line deduction means that it lowers your AGI. A below the line deduction means that it does not lower your AGI. So an above the line deduction is always better than a below the line deduction because it lowers your AGI. Okay? So moving on to another big topic is the 1099 threshold. That's increasing starting in 2026. And this is huge for business owners because starting with the 2026 tax year, the reporting threshold jumps from $600 to $2,000, and it'll be adjusted for inflation beginning in 2027. So this means fewer 1099s to file and less administrative work. And keep in mind, the $600 threshold is very, very low by today's standards, and it's been around a long, long time, since the 1950s. So what's affected? Form 1099 NEC, which is non-employee compensation. You would use this for independent contractor payments. Form 1099 MISC, which is for certain non-wage payments or other income generally. It affects backup withholding rules and also settlements. Those are penalties or emotional distress damages. Now, one thing to note is for contractors, be sure to get the W-9 completed and returned before releasing a check, because if you've ever issued a 1099 before, you've probably encountered not having a Form W-9 for a contractor and having to try to get it later. And it's like pulling teeth. That is, if you can even get a hold of that person. So also do keep in mind that even if the 1099 income is not reported, the income is still taxable to the contractor. So just keep that in mind. And net, this is a huge win for small businesses. I'm looking forward to it. Moving on to the next slide, we have bonus depreciation, and that is back at 100%. It's been fully restored. HR 1, the One Big Beautiful Bill, reinstates 100% first-year bonus depreciation for qualified business property. And this was previously scheduled to phase down to 20% by 2026 and completely eliminated by 2027. So if you buy, say, $20,000 worth of new equipment, you can deduct the full amount in year one instead of depreciating it over, say, 5 to 7 years. So it's really a great time to think about those business investments you've been thinking about or putting off. Now, speaking of expanded eligibility, businesses can once again fully deduct the cost of qualifying purchases in the year they're made. This includes, but is not limited to, the acquisition of the following types of assets: commercial vehicles, computers and office technology, industrial equipment, tools, machinery, office furniture, and even some building improvements. Now keep in mind, this is for qualifying property acquired and placed in service after January 19th, 2025. Moving on to the next slide, we have small business tax advantages. These are some new deductions, or maybe new deductions made permanent. So first up, we have the QBI deduction. That is now permanent. QBI is qualified business income, also known as Section 199A. It's here to stay, and it applies to sole proprietors, partners in a partnership, S-corp business owners. They can potentially deduct up to 20% of qualified business income. And that's a really big benefit. Now, do keep in mind there's a thing called SSTBs, which is specified service, trade, or businesses. It's a classification given to certain businesses. So if your business provides services rather than a product, the business likely classifies as an SSTB. And this is important because an SSTB reduces or eliminates the 20% QBI at higher income levels. And those start to phase out for single filers at $191,950, and for married filers, $383,900. So SSTBs, those professions or occupations are generally things like stockbrokers, financial services, accounting, legal, healthcare, consulting, and even performing arts. And next up, we have research and development. These write-offs just got more flexible because now, and in some cases, retroactively, small to medium-sized businesses with $31 million or less in gross receipts can expense R&D costs back to January 1st, 2022. Others can deduct domestic R&D expenses over 1 or 2 years instead of 5. So if that applies to you and you need to go back to January 1st, 2022 to amend a return to claim these R&D expenses, you would need to file an amended tax return in all likelihood. So next up, we have some key takeaways and next steps. Employer considerations. It would probably be a really good idea to schedule a tax planning session with your tax or financial advisor this year. It would also be a good idea to review equipment needs and potential purchases before year end. It would be a great idea to implement compliant tip and overtime reporting systems because your employees are going to rely upon you as an employer to report their tip and overtime reporting. And I don't know if you've heard this, but an interesting statistic is that after just 2 payroll mistakes, over 60% of employees will consider leaving their place of employment over 2 payroll mistakes. So you don't want that to happen because you know how hard it is to find and train the right employee. So you want to keep them happy. So be sure you're tracking your tips and overtimes for your employees. And finally, update your employee handbooks with the new tax policies. That's very important. Even though we all know nobody really wants to do that. So finally, we have some additional resources. You can learn more about HR 1 or the One Big Beautiful Bill in OnPay's newest article. It's linked on this slideshow, and we can include that in the description or in the show notes. You can chat with OnPay's team about how they can support your business. And if you missed some of today's webinar, we have a great recap. We'll link it down below in the show notes or in the chat. So you can check that out and share it with someone who needs to see the information. Thank you so much. Alyssa, did you have any questions for me, or did any good questions come up in the chat that you'd like me to address?
There are none at this time. We'll take a synopsis of all the questions that come through in the comments and also that have been submitted by the audience in the chat, and we will follow up with another video.
Excellent, sounds good. And everybody, thank you so much for joining the webinar. We really appreciate it. And just keep in mind, things are continually changing. If you want to stay updated, be sure to follow OnPay either on YouTube or on their webpage. They post a great blog post. It's very informative and it's pretty up to date. So thank you so much, everybody. Thank you, Alyssa, for having me, and take care.
Thank you so much, Noel. Everybody, as a reminder, you'll be receiving an email with a recap of today's slide, and we appreciate you for joining today. Thank you so much.